So, in the world of finance, what really brings down the giants? It's often not what you can see on a balance sheet. No, it's a hidden vulnerability, a structural flaw that can cause a system-wide collapse. Today, we're taking a deep dive into that very vulnerability, funding liquidity risk. It's the architecture of financial crisis itself.
Okay, here's how we're going to break this down. First, we'll challenge the story you usually hear about how a crisis starts. Then, we'll look at the engine that's actually driving the risk. From there, we'll trace the dangerous spiral that follows, see the permanent damage it can leave behind, and finally, understand how this has completely rewritten the rules of modern finance. All right, let's jump right in. To really get a handle on funding risk, we have to start by tearing down a pretty common misconception about why financial institutions actually fail. Trust me, it's not always the story you hear on the news. This slide is absolutely key. On one side, you've got the conventional view. A company goes under because its long-term assets just aren't worth what it owes. Simple. But the structural view tells a much different, much scarier story. The firm itself could be perfectly solvent long-term, but it fails because its short-term funding gets cut off. The crisis doesn't begin with insolvency, it begins with illiquidity, the simple, brutal inability to pay today's bills.
So, if it's not always about bad long-term assets, what is the real culprit? Well, that brings us to the core mechanism, the engine of this fragility, which is built right into the fabric of modern finance.
So here it is, the formal definition. But let's make it real. Imagine you have bills due every single day, and the way you pay them is by taking out a new loan every single day. Funding liquidity risk is that terrifying moment when your lenders just say no. Suddenly, you're forced to sell your valuable long-term investments at bargain basement prices, not because they're bad investments, but just to get the cash you need to survive until tomorrow.
And this risk is baked right into a very common business model. It's basically a three-step dance. Step 1, borrow money on a short-term basis. Think overnight loans. Step 2, invest that money in long-term things, like mortgages. And the whole thing hinges on step 3. You have to continuously roll over that short-term debt, day after day, without a single interruption. It's an engine that has to keep running.
And what's holding this whole complex structure up? It's something surprisingly fragile. It's built entirely on the continuous, unwavering trust of those short-term lenders. The second that trust falters, the entire system is at risk. So what happens when that trust finally breaks? It's not a localized event. It's a shockwave. It triggers a domino effect across the entire market. In this section, we're going to trace that cascading failure, a feedback loop that's known as the liquidity spiral. It always starts with a feeling, a shift in sentiment. Maybe a bad economic report comes out, maybe a rumor starts to spread. All of a sudden, lenders get nervous. They decide the safest thing to do is just to pull back and hold on to their cash.
And the immediate result of that? Well, institutions that can't get their daily loans are forced to sell assets to raise cash. This isn't a strategic move. It's pure survival. Now, what happens when everybody is rushing for the exit at the same time, all trying to sell the same kinds of assets? It's just simple supply and demand. The market gets flooded and prices, well, they plummet. And here's the next really nasty link in this chain reaction. As asset prices fall across the board, the value of the collateral that's backing up all other loans in the system starts to shrink. What was once considered a safe cushion is now looking dangerously thin. This, of course, freaks out the lenders even more. They see their collateral protections evaporating, so they demand even more collateral or just stop lending altogether. This intensifies the original funding crisis, forcing even more asset sales, and the spiral just spins faster and faster. So this is where two distinct types of liquidity just smash into each other. You start with a funding liquidity problem that's about one firm's ability to pay its own bills. But that snowballs and directly triggers a market liquidity problem, where it becomes impossible for anyone to sell assets without crashing the price. One firm's problem poisons the entire market. Okay, so let's talk about the wreckage this spiral leaves behind. This isn't just a temporary storm that the system weathers. No, this dynamic can inflict permanent, irreversible damage on what were otherwise healthy institutions. There's a perfect quote from the source material for this: liquidity and solvency blur. And it's so true. When you're forced to sell a perfectly good long-term asset at a fire sale price, your balance sheet takes a massive, real hit. A temporary cash flow problem can make a fundamentally sound institution look insolvent on paper. And that's the absolute key.
Selling an asset for 70 cents on the dollar, when you know it's worth a full dollar, isn't a temporary issue. That 30-cent loss is a permanent destruction of capital. It's a hole that's been blown in the balance sheet, weakening the firm forever.
And here's the kicker. Because so many institutions are using the exact same borrow short, invest long playbook, this isn't one company's problem. When the crisis hits, it hits everyone at the same time. This is a system-wide vulnerability. It's systematic.
So this much deeper understanding of funding liquidity risk hasn't just been an academic thought experiment. It's actually led to a whole new paradigm. It's fundamentally rewired the theory of modern finance and how we think about the price of risk itself.
You see, for decades, if you wanted to figure out what an asset was worth, you'd look at the big economic picture, things like GDP growth or consumption. But the study of funding crises has shown us that that is a dangerously incomplete picture. The modern focus has shifted dramatically. Now, we have to look at the financial system's plumbing, the intermediaries, the banks and funds, doing the actual trading. We have to ask, how healthy are their balance sheets? How tight are their capital constraints? And the big one, what happens to an asset's price precisely at the moment when these crucial intermediaries are under stress?
This has elevated funding conditions to what financiers call a state variable. Think of it as a vital sign for the entire financial system. You can't really assess its health or the value of anything inside it without first checking this critical reading. How easily is money flowing right now?
And all of this leads to a powerful and kind of scary paradox, summed up perfectly in this quote, "Stability breeds instability." It means that those long, calm periods when money is cheap and everything seems fine, they don't make the system safer. They actually do the opposite. That stability encourages more and more risk-taking, quietly planting the seeds for the next crisis.
Which leaves us with a final, really provocative question. If the risk of a crisis isn't some random external shock, but an inherent feature of the way modern finance is actually built, born from the very mechanisms that keep it going in good times, then what does it really mean to build a safe financial system? What does safe truly mean?